Hi there, how are you? Welcome back to M Talks. In continuation with our topic Money Works. In the previous session, we saw how it all began money. More importantly, what was the basic utility with which money came into being? Medium of exchange. As time went by, business, trade, economic activities started growing. Money took on larger functions, became more and more important. But the most important function that money provides is that it determines value. Most of the items today, be it commodities, goods, services, all of them are expressed in money terms or valued in money terms, quantum of money. Money, however, does not determine the value. Value determination is done by market forces like demand, supply, and so many other different factors. Money only defines value. If money is the heart and soul of an economy, the banks are its body, which nurtures and protects them. Money today, in all its glory, would not have been possible without the banking system. If you look at the history of banks, they're as old as money itself, if not older. There are recorded transactions of what today we would call merchant bankers providing grains to traders and farmers those days, and also lenders lending in the form of commodity to be repaid back in the same commodity as the same commodity with some additional quantity as what today we would call interest. In fact, those days, most people used to keep their valuables in places of worship for safekeeping because these were considered safe and the people who managed them were honest and of high integrity. But the thing is, whenever a kingdom gets annexed or taken over by another king, the places of worship were the first ones that they ransacked. We always thought this was because of religious differences, but now we know. And then, when gold and silver became an integral part of what we call money, integral part of exchange, a new set of players came into being the goldsmiths. The goldsmiths, with their unique skill sets to store and more importantly, their capability to value these metals, started playing key roles. People started keeping their valuables with them, like gold and silver and so on and so forth. So the goldsmiths used to take these on for storage and issue receipts confirming the quantum and more importantly the quality of these valuables. So the person carrying a receipt, his creditworthiness is, I mean, it's a new term, it's a recent term, but that was more or less established with this receipt. The receipts were not transferable, as in it cannot be exchanged for any commodity or cannot be traded because the original receipt holder has to go to withdraw his deposits. Anyhow, as this activity grew, the goldsmiths also started charging a fee for this. And then, when they realized that these deposits were lying with them for long periods of time, and none of these gold or silver or valuables were marked in the owner's name, they started loaning it for shorter periods of time to small businessmen and traders and charged for this as well. So, this is how the rudimentary banking grew or started, I should say. And then it was under Julius Caesar who created a form of structure for banking. In fact, he passed an edict where bankers who had loaned money based on land or other forms of securities can actually confiscate them if the borrower defaults on them or does not pay them back. If we think banking started off more as retail or banking for people like individuals like you and me, then that's not correct. Banking started off essentially as a treasury function for kings and kingdoms to evaluate and store their valuables, not just their valuables, but whatever taxes were collected. And they also used to loan smaller kingdoms under a larger king to be paid back with interest. And monies were also drawn by the kings for, let's say, financing a war or development activities. There are also kings who have supposedly bankrupted their kingdom. I mean, that's how the first bankruptcy word started. It happens even before it became part of a system. All these activities, which were provided by individual sets of people, today are housed under one roof and provided by the modern bank, be it merchant financing, trade financing, safekeeping, which is taking deposits, keeping your money safe, or providing loans for people who need them. And for all this, the banks have only two types of income: a fee based income and a fund based income. What do I mean by fee based income? The bank charges a fee when you ask for a service. For example, if you want a draft or a banker's check, if you want a credit or a debit card, there is an annual fee. If you want a checkbook, these days they charge you a fee as well. So this is part of the bank's income. The other income is a fund based income. The bank sources deposits from all sorts of people, different types of people, all categories of people, and they loan them to people who need short term or long term funding. The difference in interest between what they pay the depositors and what they collect from people who take from them is revenue for the bank as well. Banks are the backbone of the financial system in an economy. They provide an absolutely critical function in an economy, which is liquidity. When I say liquidity, especially for the economy, what does that mean? You see, banks with their reach across nooks and crannies of an economy, reach to the smallest household in an economy, has access to funds from these people. Because today, as the backbone of the financial system, all transactions, all legal transactions, we're not talking about the ones outside the system, happen through the banking system. So the money, whether it is your salary, whether it is somebody paying you for some service that you provided, whether it is payment for, let us say, some a trader getting payments, whatever, it goes through the banking system. So all this money flows through the bank. So the bank has access to all this to be able to provide, let's say, if there is a short term loan or a long term loan for a small business, for a large corporation, even sometimes to government. So, if, for example, a large corporation or a business does not have access to funds with the speed and the ease that the banks provide today, they will suffer. If they suffer, then the economy suffers because then employment suffers. It's a snowball effect. So, economies are completely dependent on the banking system because of this liquidity factor, which is why governments are very careful to maintain credibility of the banking system. They protect the credibility of the banking system. They also set up bodies which govern the functioning of the banking system by establishing certain sets and processes. They are called by different names in different countries. We are not going into the details here. So, what does this mean to us? Simple. Banks are a safe banks are safe establishments for us to transact with because they are backed by the government, protected by the government, and their credibility is anyway ensured. But the other thing that we need to keep in mind when we are talking about banking is something that we are all aware, But how much cognizance we give to this in our own personal finances is still a question. We all know money erodes in value over a period of time. The value of money or the value of goods and services money that a certain quantum of money could get you 10 years back is not the same as today. It's much lower. Percentages vary. In some economies, the value deterioration is lower, some economies are higher, but it is definitely there. And this happens due to various factors: inflation, population, so many different factors. We will take this up in a completely different session. But the fact remains that it happens. So, how does it equate to your earning? What you earned, for example, 10 years back, is not the same value today. The value is much lower. So, it is up to us to establish within ourselves what the value erosion is and make sure that it is compensated. We, in our hurry to continue making money, we don't stop and think about this. Okay, we are continuing to get money, fine. And sometimes, yes, we make more money, but that's directly linked to your effort and your capability and your competency. But there is something which is taking away all that slowly but steadily. So, what you must do to ensure that the value of what you earn, value of your earning, is retained. There are different ways to do it. Even if you keep it in a simple fixed deposit or a recurring deposit in a bank, it's we have to ensure that the interest accrued is higher than the value erosion. That's one thing. We all take loans. Not all of us have access to huge amounts of money to make large investments or big purchases. Or forget it, even if we were to take it for something minor, like for a travel or a holiday expense. When we calculate the cost, we look at, of course, the actual borrowing. There is an interest component which the bank charges for funding you. So we take the interest component, for example, if it is for purchase of an asset, let's say a car or a house or something, we take the interest component as an expense. Now, do we factor in specifically if the loan is tenured, meaning it's for long periods of time? Do we factor in the value erosion of money into this? I don't know if a lot of us do this, but it is important to factor in as well because it is an additional expense that we have not anticipated. How this happens, how to estimate the quantum, we will handle in a different session. But for now, let us be aware that there is something like this that exists, that happens. We have to take this into cognizance. We have to consider this when we are working our personal finances. Okay, with this, I'm going to end this session. The next one, I'm moving on to a different subject altogether, which is risk mitigation. We're going to talk about insurance products and how they work. Thanks for listening in to me. Thanks for tuning in. Stay happy, stay healthy. Bye for now.